Well, good morning, everyone. Are you ready? Today we are talking protective strategies, and no, you will not be enjoying the dulcet tones of Mr. Ben Watson today. He has a well-deserved day off after spending the weekend in Miami, teaching teaching what he does oh so well, introduction to technical analysis and introduction to options. If you haven't attended one of those, we're hitting different cities all around the country. I encourage you to check them out. But today we're talking protective strategies. So what are we going to talk about? We're going to talk about a couple of my favorite emotions, hope. And I'm a very optimistic and hopeful person, but hope is a four-letter word in the world of trading. And as a strategy, it can work out sometimes, and it can be decidedly ineffective. Another a four-letter word in the world of trading is FOMO. And, what do we do when FOMO comes our way? And we're going to talk about how we can embrace, that four-letter word and hope and use it to our advantage in trading and the effective use of protective strategies. And so we have 5 stocks that I want to look at today. And 2 of them are currently in an example portfolio. So we're going to look at how we might peruse a portfolio that currently exists. And then we're going to place a couple of new trades using protective strategies as part of placing a new trade. So we have a lot of ground to cover. I don't get to cover this class often, so there's a lot that I'm going to try and cram in. If you are not following me in the land of X, I invite you to do so. My handle, Barb Armstrong CS for Charles Schwab. We have the privilege of having Brent Moores with us in the chat today. Brent is a friend and a fellow coach. His handle, Brent Moores CS, and we invite you to follow us there if you aren't doing so already. Also want to thank all of you who bring this class to life by participating in the chat. So hello to Sandeep and Eric and Ricebird, like the usual suspects, Scott and Robin and Greg and Sharon and the Maligator and the rest of the gang. Thank you all for being here. And being so participatory. Just know, spoiler alert, occasionally, and this is actually a compliment to each and every one of you who do follow me on Twitter and follow Brent and the other coaches. And I guess a backhanded compliment to each of us is that we've seen a rash of imposters lately. And so just know that no coach will ever reach out to you and offer you a Bitcoin or a crypto deal. We will never say, please give us your account sign-in information, and we'll go in and how about I trade the account on your behalf and we'll split the profits. Like, yeah, don't do that. That's a thief. That's an imposter. So we won't offer you private education, any of that stuff. And these are all scammer things that I have seen. So just beware. And if somebody does approach you, just know that it's not us. Please take a screenshot. And the chances are this handle is going to look very similar, but it's just not quite the same. The latest one is they've just added an underscore at the end. So anyway, be forewarned on that. So what do we want to just remind you of as we start this process and then go in and start looking at the charts is that we are using the paper money application. It is for educational purposes only. It is on the thinkorswim desktop platform, and it is a brilliant place to learn. And it's a brilliant place to become familiar with how to use the thinkorswim platform. It looks like, smells like, feels like real money, but it's not. But just know that American-style short options, which when we sell a covered call on a stock, that can be assigned at any time. Right up from the time we place the trade up until expiration, but we'll never see short options assigned early in paper money, but it can happen in a live account. And so we just need to be aware of that. And selling covered calls can be part of one of the protective strategies we're going to talk about today. Know that if we place a stop loss order, it's not a guarantee that we're going to get out at the price we requested. If a stock gaps down, particularly after something like earnings, although a stock could gap at any time, we could end up out at a much less appealing price than we were planning on. Okay. So let's just be aware of that. Okay. We are not going to talk about futures in today's class. But so we're going to talk a bit about what protective strategies are and what some of the benefits, the pros and cons of various protective strategies are. We're going to talk today about protective puts. We're going to talk about callers, which is where we sell a covered call and buy a protective put at the same time. We're going to talk about stop loss orders, and we're going to talk about hope as a strategy. Yeah. So we got a lot we want to talk about here today. And then just for those who like attending live events, and as a client, I was one of those. I would get in my car when I lived in Michigan. I'd drive to Chicago or Cleveland, or I'd get on a plane and fly to DC. I ended up with this job actually because I flew to Salt Lake City to take a class in the Salt Lake City area, and met the guy that they brought in to revamp the whole thing. And I walked away with more knowledge on options and eventually a job. And I still love attending these live events. So if you haven't attended one, I think they're a great investment of your time. They are free to attend. You just have to get yourself there. And so the next one is at Santa Clara. It is booked. You can no longer register. I think if you showed up, they would not turn you away. But I tell you that this one is fully booked, and I'm going to be at this one because if you're thinking, oh, I live in Denver, maybe I'll go to that. Let me just see how things are with the kids. Register now. You can always cancel your registration. We don't send you a bill if you don't come, but it's likely to end up maxed out also. So, register and then, cancel your registration if you're not coming so that we could open it up for others to attend. And I will also be at the one in Times Square in New York at the end of October. It's somebody asked if I'm going to Houston. I was assigned to that one, but I think now it'll be Brent Moore's that will be at that event. Okay, so let's come out and have a look at what's going on in the markets. So we are going to look at Roku. That is our hope example. So let's see what's going on with the S&P 500. So the S&P 500, it's up almost 20%, 19.6% year to date. We had this period of consolidation. I'd call that a cup and handle pattern. It has broken out above that and looks like it's kind of the last couple of days come back to retest. Some might look at today's candle specifically saying, well, it looked like it opened lower and it is rallying. Perhaps this pullback is drawing to a close. And we'll only know that, when we see, a close above the high of the low day. Greg is saying he's booked his ticket for New York. I'm thrilled, Greg. Please make sure you come up and introduce yourself. I'd love to meet you. We'll take a selfie and we can post it on Twitter. That when we come to the NASDAQ, what do we got? Something pretty similar. Now, this pullback was a little deeper, but again, if we're playing I Spy with my little eye, I would call that another cup and handle. Oh, look at that. I posted something on Twitter yesterday with a stock, and it just turns out that, this all works beautifully. I didn't erase it, but this is another kind of cup and handle pattern where it broke out and it's come back. And it did kind of break this line, but it looks like, again, today, similar to the S&P 500, that it's rallying. And so we'll just have to kind of see how this plays out. Let me close out my drawing tool. How about the Dow? Now, when I first looked at things this morning, so the Dow has been in this upward trend, not quite up as much, up 12% year to date, though, which is pretty amazing. So we've got this upward trend. It broke out above this diagonal resistance line or ceiling and appears to be bouncing today. And so all of this looks pretty bullish, doesn't it? And then how about the Russell? This is our small caps. It is in fourth place at, but still up 8% year to date, and was setting up a bit of a pennant pattern, where we have a series of higher lows. So, uptrending, but then we had a high and then a lower high. So setting up a bit of a pennant pattern. It broke through that And it looks like maybe this old ceiling may now be acting as support. And it's come down and retested this support line twice. But looks like it may be bouncing. So, we'll just have to wait and see. We don't tend to trade as many of the caps in the small cap index, but it's good to have a feel for what's happening. And the VIX is kind of at the upper end of where it's been, at 18.73. It has spent a lot of time in the last year below 15. So to be at 18 is kind of at the higher end of the range. It had a big move up yesterday. Looks like it may be ready to come back down. Yeah. Yep. Okay. And when we look at sector strength, if we come, because I looked at the stocks on the Dow when I was looking for examples today, because I like the way the chart on the Dow looked. If you're wondering where I found my examples, I'm having trouble talking and doing things at the same time. My multitasking is a little weak. But, when we look at, which sectors have been strongest, utilities, consumer discretionary, communications has been strong, industrials, and technology kind of moving up to the middle of the pack. Over the last 3 months, utilities again, real estate, industrials, materials, financials, kind of interesting. They're in there too. Yeah. Yeah. You guys are so funny in the chat. Somebody saying Axe from Twitter to Axe, as in all my exes live in Texas. I thought of when they first changed the name to Axe, it was like if you were not an educated person and couldn't write, you would sign your name with an X. So I thought, like, is it X as in illiterate people tend to use Twitter more, which, doesn't speak well for me, right? Or is it X marks the spot, which is where on a treasure map you'll find gold. So I'm going with the X marks the spot, and here's where you'll find golden nuggets of wisdom from all the coaches. Yeah. So, okay, so let's look at our first example. We're going to look at AXP. So, and you may say American Express, but financials have been kind of in the middle of the pack. Here's a stock that's up 43% year to date, and it's just been kind of marching up the hill. And when you look at it and you say, well, here it kind of gapped down on this earnings, a year ago, but the last 3 earnings, like that was a pretty dramatic move to the upside. And then, the 3 days past earnings here, like this was a pretty positive response to earnings. And then with this one, it dropped down and then kind of rallied. So it's up, the trend is, you can't deny that this trend is uptrending. I kind of hate to miss out if it gaps up, but I don't want to get hammered if it goes the other way. And we do have earnings coming up. Yeah. So earnings is coming up on the 18th. So if I wanted to add American Express to my portfolio, let's say I don't have a lot of financial stocks, and if I come here and I look at the monitor tab, well, I've got Schwab and I've got Bank of America here in the stocks with dividends. So we've got 2, but if I wanted to add this third, what might I consider doing? Well, what if I added a protective put just to get me past earnings? And if earnings is on the 18th, actually there's and it's before the market opens. Okay. So if it's before the market opens, could we come out to American Express on the 18th? And where might we if we were going to use a stop loss, where might we put a stop? Well, we might say, well, if we come back and we look at, even a 9-month chart, this 100-day moving average has been acting as a support level. So, but would I really want to, buy at 270 and then put a stop 3% below 244? I might not. I might say, well, here's my, here was a recent high. It broke above that. which is also close to the 30-day moving average. What if I said, hey, if it went 3% below that 260, so 260, 77 times 0.97, so 252. So could I come out and look at a protective put around this, say 250? Have we got lots of volume, over 2,000 contracts? What's our probability of it ending up in the money? Only 17%. But I'm buying, I'm buying protection here, and protection isn't free, just to get me through earnings. And this expires on the 18th. So when earnings comes out, if it gaps down and it goes below 250 and I decide to sell, I'm going to have to make that decision pretty quickly. Or if I say, well, I could at least sell this and maybe I'd have a bit of a profit, that might take the bite out of what I've lost, if it comes down. But you might say, well, is there a way I can mute this expense of $1.78? But, when you think about it, this $1.78, before we go, throwing nickels around like they're manhole covers and being really cheap about this, this is let's call it a $270 stock. And if I, spend, let's call it $1.80 to protect this over earnings, and I divide that by 270, that's like half of 1%, I think. It's 0.6 of 1% or 0.7 of 1%. So it's not a really hefty bill. But if I said, well, you know what? It's trading at almost 270. If I sell a covered call that expires the same day at, say, 280, what's the worst case is if it goes above 280, I get called out. What are the odds? This is saying the probability of this being in the money is about 28%. So I've got a 72% chance that I get to keep this 350, and it will have more than paid for this protection at 252. In fact, if I wanted to kind of just do it as a break even, I could say, well, if I sell this 280 and I get paid 345, I could move this stop up to, 257.50. And then I'm taking less risk. And what are the odds of it going below 257.50? 28%. So I'm not selling this covered call as a way of making money. If I am called out, I've made $10 a share, plus a little bit, plus a thimbleful on the covered call. But if I make $10 on a $270 investment, and I am called out and I'm only in it for 16 days, well, that's a 3.7% return. So am I okay with that? And I know, I'm kind of walking you through stream of consciousness by Barb, but I'm trying to kind of give you a sense of how a trader might look at this. And so what we're going to do is we're going to come here, we're going to buy 100 shares. Okay. And then we're going to change our advanced order to single order and make it a first triggers all. Because we're going to come up here and say, we're going to sell this 280 call. Now it expires on the 18th. And we're selling this call as a way to fund our protection. And we could go back here to the 250, or we could come up here if we're saying we're willing to spend most of what we've got here. We could come here to the 257.50, and there is no right or wrong answer. What this does is it guarantees, it gives us a way that we have the right to sell this stock for $257.50. Now we're paying $269 for it, so we'd still be down. We'd still be down to the tune of $12. But let's say it went down to $250. We'd have eliminated $7.50 in potential loss. So it's a way of defining our potential loss. So we are going to come here and just buy the 257.50, and we're funding that with the sale of the call. So this is kind of a break even. And, you know, these, our intention is for all of these to fill. Then after the 18th, what would we do? Well, we'd come in, and if both of these expire worthless, then, you know, and we still own the stock, then we might come in and add a stop. But it's a way of purchasing the stock and having some coverage. Okay. So we're going to come back to our trade tab, confirm and send, and we're going to put this in our callers over earnings group where we bought the stock and we put a caller in it over earnings, so that we know when we come and we do our weekly review of all our positions, if that's what you do, you're going to look at that every time, because you don't want to have an unprotected position. Because if you have an unprotected position, how much are you risking? Well, technically, if you paid $270 for the stock, you're risking $27,000. And you may say, well, what is the probability of American Express, you know, going to zero? It's very low, but it's possible. You know, so it's saying here, max loss is 26,992. It's what you're paying for the stock. Now, it's not taking the account that we're buying a put to protect this position over earnings into account. Okay, so we're going to send that in. Okay, now I want to talk about, you know, hope as a strategy, because I've been waiting forever to bring this up. I had something I put in the hope category, and I don't really, this is an account with $1 million in it. And we actively manage our trading a smaller account, but I don't actively manage this one. And this one, we're down $6,772. If we look at that as a percentage, so profit and loss percent, let's add that just to, you know, rub salt. We're down 30%. Now, one time we were down more. So let's look at Roku. And Roku, we bought this one. I just started this account back in November of last year, but we bought this, as it turned out, at the all-time high or pretty close to it. So we bought it on this day here. And we didn't have a stop on it. Or maybe, you know, we obviously didn't have a stop, because if we'd had a stop, you know, 3% below this 30-day moving average, we would have been stopped out. And we didn't, you know, update our stop. And then it fell over earnings. And here's an example of, had we had a protective put, when it fell, we might have chosen to use that ability to exit that trade, maybe around the $80 mark. And instead, we held on to it, and it went down all the way to 48.33, and we paid what for it? Over 108. So, you know, at one point we were down like over 10,000 probably on this one. But if you look at this and you say, okay, what can I learn from this? Well, you may say, well, I think Roku has a good product, it's a good company. Well, you can cheer them on all you want, but maybe we would have been better to be cheering them on from the sidelines. But, you know, it's made a bit of a comeback, hasn't it? Since it hit this low here of 48, and some might say, well, I kind of see this big kind of cup and handle-ish type pattern setting up. And it's now come up, and it seems to be consolidating here around this 73, seems to be acting as a support level. Now, we don't have earnings until November 6th. So what we may do with this is say, hey, time to take hope as a strategy and put it over here and say, okay, I tried that. Didn't work out as beautifully as I would have liked. Now I'm going to add a stop loss to this order. And I'm going to take this 73 Or we could, even if we want to be more conservative, say here was the low this day was 71.74 times 0.97. I'm going to put a stop at 69.58, which means that we're hoping that that's below this level of support also. So the hope is that we wouldn't be, stopped out, especially like getting nicked out on a wick. And right now, how much risk do we have? Well, we have 7,000, $15,000 worth of risk, because that's, what is currently trading at. And technically it could come back down here to 48 or below. It could go to zero. And I know you guys may think, well, that's ridiculous. But Peloton, if we come back and we look at a 5-year chart, this stock is now trading under $5 a share. And at one time it was at 171. Or if we look at Weight Watchers, it has lost a lot of weight. If you come to a 10-year, it was at one point over $100 a share. It's now under $1. Yeah, so, we get to learn from our mistakes. But it would be a mistake to continue to not, perhaps, it might be a mistake to continue to just let this kind of go with the flow. So we're going to come in to our monitor tab. We are going to create a closing order with a stop, and we're going to put this at 69.58. And then when it gets closer to earnings, we may decide to take the stop off and add a protective put instead. Okay. I'm not going to talk about China specifically today, but there is a class coming up today taught by Mike Fairborn, where that would be a really great question to pose, where it's market and sector analysis. Okay, because I kind of have my whole outline of what I'm covering here. So good question, but stay tuned for market and sector analysis, which is coming up a little later today. So we're adding a stop loss, and we're climbing out of the hole of hope here. Now, what happens if you have stocks? So we've done a new trade on American Express. We have we have added a stop to Roku. The reason that I kept these open here, so these are stocks that pay a dividend. And one of the things that we may notice here is that several of these have earnings coming up. And one of my frustrations over the years has been that I'll have a stop on something, and then, it gets nicked out on a wick over earnings. And, and then I'm frustrated because then by the end of the day, it's gone back up and I wouldn't have been stopped out at all. And so sometimes when we have earnings coming up, we may just want to come in and have a look at when earnings is and then adjust our stop. So let's look at RTX. We're up 18% on that. We have a $5,736 gain. We've given back $33 of this, and this is unrealized gain. So we all know what the market giveth, the market can taketh away. So if we look at this and we say, well, earnings is the 22nd, and let's come in and look at where our stop is on RTX. And if you're wondering how I'm getting these stops to show up on the chart, if you come to your sprocket, you can just say show orders. So, and if you just unclick it, then, your stop loss will go away. But if earnings is coming up the 22nd, maybe we want to look at this and say, if we put a stop, and let's activate this. It seems like we've got some support here. If our stop was 3% below this 117, what would that be? 117, say 117, 76. Our stop would be around 1.7. Whoops. I typed that in incorrectly. 117.76 times 0.97. So our stop would be around 114-ish. But instead of doing a stop, could we come out to the closest? October 18th won't work because earnings is the 22nd. Could we come out to the 25th and say, how much would it cost us to put a stop around this 115 mark? It was 114.22. Or we could say, give us 22 strikes here. So you could do the 115, we could do the 46. Now, what are the odds of it coming down and being below this 115? It's only 14%, the probability of it being in the money, but you have a 27% chance that it could come down and kiss it. And you know, and all it has to do is kiss it, little peck on the cheek, and your stop is triggered and it will sell at the next available price. And then it could go up by the end of the day. So might we want to spend 54 cents to 61 cents here to add a protective put? And we'll just take off our stop until we get past earnings. And, you know, we're putting our stop here at 115. So we're trying to protect $10 worth of the profit we've gained so far. Now, $9.39 is still at risk. But if we're okay with that and we're going to come here and we're going to just cancel this order. And so we should see this disappear shortly. The other way to cancel the order is to come here and I sort them by symbol and then come down, and now you can see this RTX is gone. But if it was still here, we could have just clicked here and canceled our order that way. So we've got our order canceled. So now what we want to do is add a protective put. So we've got 300 shares we want to protect. We're going to come to our trade tab and we're going to do this 115 strike, and we are going to buy a single, and we are going to buy 300 of those. And we're going to see if we can get in for maybe a little bit less. To see if we can get in for closer to the midpoint. And this is, do we have a protective put group? We don't. So we're just going to leave it in the group that it's in, which is our dividend stocks. Stocks that pay a dividend. And we're just going to put in a note that this is a protective put over earnings. Now, could we also pay for the put by selling a covered call? We could. Or we could just say, you know what, for this one, I don't want to cap my potential gain on this. I would rather just sell the put. But could we have come in and sold, say it's trading at 124. Could we have sold a covered call at 130? Could we change our minds and add that? Sure, we could. You know, it's never come up to 130 before. So if we said, well, you know what, I kind of like the idea of selling that 130. If I come out here, there's only a 27% chance of it being in the money at expiration. So could I come back and add that? And we could. So we could say, well, I'm going to sell 3 covered calls, and we could add that. You don't have to do them. And this is on a current position. So we're going to add this to our dividend. Actually, we're going to put this into our callers over earnings, because now it's gone from a protective put to a caller by selling these 3 calls. So I'm selling these 3 calls, and then I'm going to come down here to my RTX, and I'm going to move this up to the callers over earnings group. So now we've just bought a stock. So that was an example of buying a stock with a caller and then taking a current position and adding a caller to it. Okay, are there any questions about that? Okay. Let me just look and see if we've got questions. Yeah, so this class and market and sector analysis were swapped at least till the end of the year. Yeah, but Mike Fairborn is still teaching that. Yeah, so Ford Checkout is saying from your June session, he bought Roku, which is up now 91%. So it's all a matter of timing. Never say that timing isn't important, right? Yes, and Ford Checkout is saying, I very much doubt that RTX will hit 115. Yeah, so why not buy? And someone else said, why not buy a higher strike price? And we absolutely could have. The reason, so here's my logic, is if I were to leave a stop on this coming into earnings, I might say, well, we had an old ceiling on this, which was here. And then, it broke out above that ceiling here, but it came back and retested it here. And then it's been it hung out here for quite a while. So if I look at this 117.76, and I said, well, I could see that as a pretty solid support level. If it goes 3% below that, and I know I already talked about this, but I guess it bears repeating, 117.76 times 0.97, if I were to put a stop on it, I would have put it around that 114 level. And so if instead of a stop, which could be nicked out on a wick, or which could be triggered if it gapped down, like it's gapped up, so that which gaps up can gap down. How do I know that? Because I once, as a relatively new trader, saw a stock that had gapped up over 3 earnings. And so I placed a trade expecting it to gap up. And what did it do? It gapped all right, but it gapped down. That was not a happy day, pour moi. And so, if it can gap up, it could gap down, and it could gap down below that 114, or could gap down and hit that and then rally by the end of the day. We've seen that happen often enough. And so that's why I picked 115, because it would have been between 114 and 115 where I might have chosen to place a stop. And you're right, the odds, the probability of it going down and hitting that is 28%. The odds of it closing below that by October 25th, 14%. So it is low. So you might say, well, why aren't you saving your $55? Well, you know what? When I go to Europe, I buy a protective plan that will cover me in the event that I fall and break my arm. Am I hoping to break my arm? No. Am I hoping to, end up with food poisoning? No. But do I want to have access to medical attention that isn't going to break the bank? Should that happen? Yes. When I get home and that policy expires worthless, am I happy that I came home and didn't need to use it? You bet your sweet bippy. But do I get a refund? I do not. And yet I'm still totally cool with it. That's the essence of what a protective put does for you. It's short-term coverage, 23 days worth. But the other protective put we did, 16 days worth. So it's short-term. Okay, so do you want to see another new example? So we could have bought a higher strike put. You may say, well, I'd rather make it, 119. You can make it whatever you want. Okay, so, okay, I'm just going through the questions. Won't buying a protective put reduce the upside on the stock because the overall delta goes down? The overall delta, so this has a negative delta. Owning a stock is a delta of 1. So, but it doesn't reduce the upside on the stock price. You could say it reduces your net gain by 55 cents a share. If this expires worthless, or 60 cents a share, whatever we paid for it. Okay, so how you look at that from an accounting perspective is up to you and your accountant to discuss. For you and your accountant to discuss. Now, selling the covered call caps your potential gain. So if it gaps up and it gaps up above 130, then we might have to sell the stock. And then, that can create a taxable event because, we bought RTX at 105 and it's now trading, we'd be called out at 130. And so, we'd have a pretty nice gain, and if we put our profit and loss percentage in here, which is one of my favorite columns, just at a glance, you can see where you are. We're still up very nicely on this stock. Okay, so the covered call reduces the potential upside. The protective put does not. So the price of the put option can end up higher if you put it on just days prior to the earnings announcement, because volatility is going to go up. The advantage, though, is that you're buying less time. So here we're buying 3 weeks worth of time. Others might say, I'd rather do it like in that 10 to 14 day window. Yeah. So selling a put and buying a call is a bullish strategy. It's not a protective strategy. And that's called a synthetic. You're emulating as if you own the stock. But it isn't a protective strategy. In today's class, it's called protective strategies. And so that's why I'm discussing what I'm discussing. Okay, so now we have to wrap up. But if you wanted to practice, could we come and look at something like Caterpillar? Now, Caterpillar's in the industrial group, and industrials have been pretty strong, haven't they? And so if you said, well, we have earnings coming up not till November 5th. So with this one, if I just wanted to buy the stock, because I see this, it was kind of consolidating here. And if we kind of look at this and say, we had a range of about what? 310, about $45. And so if we expect it to go from 362 to over 400 based on this pattern, so I'm putting my technical hat on here. So we had this kind of inverted head and shoulders type pattern, or a double bottom pattern, a double-headed, double-shouldered, or you could call this a cup and handle. And then it broke to the upside. Actually, this one should come down like that. It broke to the upside. And so if we said, well, we just like to buy this, but, and then it broke out above this potential resistance level, and it looked like that's now acting as support. So if we took this 379.44 and said, I'm going to put a stop at 368.05. So I'm going to put a stop 3% below this line here, and I'm just going to buy 100 shares. And because earnings isn't until November, I'm not going to open this by doing a protective put or a caller. So, when might you use a protective put? When earnings is within the next, 2 weeks or so. And when might you use a stop? When earnings is further out than that. And so here we could come to our trade tab and just say, we just want to buy 100 shares of Caterpillar, and we're just going to put a stop loss on it. And so it's not that stops are a bad thing. They're just not necessarily, there are times when you might want to consider employing a different protective strategy. And as always with a stop, there isn't a guarantee that we're going to get out at this price. If it gapped down, we could end up out at something less. And we could say, we're just going to put this in our dividend stock group because it does pay a dividend of 1.3. And despite the fact that it's almost a $400 stock, it's the PE ratio of 18, which kind of puts it in the value category. Okay, so guys, we have done a lot. We've placed 2 new positions, one on American Express where we did a collar because earnings is coming up, one on Caterpillar with a stop loss because earnings is further out. We adjusted, we talked about hope and the fallibility of using hope as a strategy, and we placed a stop loss order on Roku. And then we went in and looked at a stock that was currently in our portfolio. So as we close, I want to say there is a survey. If you would please fill that out. 2 questions. 1, I hated it. 10, I loved it. If you have ideas you'd like to share for upcoming webcasts, I promise if you fill it out, I'll read each and every comment. I'll also pass it on to Ben so that he can use whatever feedback you provide in webcasts going forward. Hit the like button. It helps move this up in the algorithms. Subscribe to the channel. And of course, don't forget to follow us in the land of Twitter, Barb Armstrong, CS, and settle for no imposters. And if you're interested in attending a live event, we would love to see you there. So I hope you can join us. So guys, that's a wrap. Thanks for being here today. Thanks to Brent and thanks to the guys behind the scene. Take care, everyone. Have an awesome day. I'll see you tomorrow. Bye for now.